Sukumar Rajah, Managing Director and Chief Investment Officer of Asian Equity with Franklin Asset Management, joins us live from Singapore now. Sukumar, fantastic to have you back on ET Now. Thank you for joining us. Sukumar, a lot has changed for global markets and for Indian markets in between our two interaction. China is down, emerging markets are a bit shaky, but US economy has gone up. So how would you map the global scenario for equities as an asset class?
Good morning. I continue to be positive on the prospects for equities, especially in the Asian context. We see improvement in fundamentals in most countries, both growth prospects as well as margins for the corporate sector. The valuations are below long-term average, so I'm clearly positive on the long-term prospects.
Sukumar, what drives any financial market, at least in the medium term and in the short term, is liquidity. Given what the Fed has indicated that they will go ahead with their tapering plan, do you think globally we could be staring at a situation where liquidity could be a scarce commodity? And if that is the underlying concern, do you think financial asset classes, especially equities, could struggle?
There could be some volatility because of liquidity concerns, but I don't see a situation where that will dominate the behavior of the financial markets. Ultimately, the earnings prospects, the trend in earnings, the improvement in fundamentals, I think will play a more important part. And as long as there is improving confidence on some of these parameters, I think the equity markets should do well. Though, as you pointed out, liquidity could be a concern from time to time for brief periods, but those shouldn't really change the trajectory of the market.
So Kumar, one of your best performing funds over the last 1 year has been Franklin Infotech, while majority of the AUM in the funds, are invested in big boys, TCS, Infi, Wipro. Are you now looking at fresh additional exposure in the mid-cap segment here as well? Because mid-cap IT too has had a phenomenal ride.
We have been invested in many of these companies for a long period of time, and our investment rationale has been focused on the long-term ability of the company to improve their market share and maintain margins. So whichever companies we believe that exhibited or have those characteristics, we have bought most of them or brought them into our portfolio. So on an incremental basis, whether there's a lot of opportunity in going into newer names or mid-cap names, not necessarily our thought process.
Sukumar, whereas your call on large cap IT has worked like a charm for you, your other big position is private banks. Given what is happening to the Indian banking sector, are you a bit worried about your large exposure to private banks?
Our largest exposures, those banks are extremely stable. Their fundamentals have not deteriorated at all. If at all, I think on a relative basis it's improving because the other banks are struggling, which means that these banks can continue to gain market share and probably retain their margins. So our long-term thesis on private banks has not changed one bit at all.
Right, Sukumar, but the competition in the Indian banking sector will intensify. RBI soon will issue 6-7 new licenses. New licenses means better banks, more competition and impact on margins.
The new banks we don't see really impacting the prospects of well-established large private sector banks. For new banks to be of any threat, they should have a a good franchise. They should have a large branch network. They should be able to offer an ATM network and so on. And for the new banks to establish all that, it's going to take probably 10 years. So I don't really see the new banks impacting the well-established players.
Sukumar, you also have a very large position in Bharti. Given what has happened in the spectrum auction, do you think in the medium term Indian telcos could suffer? Because the fact that they will have to shell out more to acquire new airwaves, I'm sure will have an impact on their balance sheet. It will increase their debt burden and compress the return on equity.
It would increase the cost, but it would also, I think, hasten the consolidation process, because it's very difficult for the not so profitable telcos to buy or afford spectrum at the current prices, which means that they will have to exit sooner than later. So if you're going to have a faster consolidation, it means that the prices can be increased, and a more consolidated market always leads to better profitability. So it might sound counterintuitive, but increasing spectrum prices might not be so bad for the telcos as people think it is.
So Kumar, what is it that you've made of the auto pack? Well, of course, each of them is a different story to tell, but you've got all of them pretty much cutting their vehicle prices, passing on the benefit of the excise duty cut in the interim budget on to the customers. But does it really seem all this could really spur up demand?
To some extent in the short term, but from a medium to long term point of view, a 4% excise duty reduction is not going to have a big impact on the size of the market. So we don't see that as a very material development from a long-term point of view.
So Kumar, if I scan through your portfolio in last 6 months, nothing has changed. Your core position is still IT services, followed by private banks. You're overweight on telecom, and selectively you like some auto names. Do you think it's time now to revisit the core of your portfolio? Because if Indian economy makes a comeback, then cyclicals will outperform and exporters will take a backseat.
Yes, that's true. From a short-term point of view, I think some of the beaten-down stocks will do well. Yes, we have to look at some of them, but at the same time, we can't, the portfolio cannot be built on short-term considerations. So we have to look at companies which can ride through cycles, so there will be some changes to the portfolio, but don't expect very dramatic change.
So Kumar, let's talk about pharma. Whereas for IT, the mandate or the earning visibility is very clear. If US economy makes a comeback, IT stocks will do well. But that is not the story for pharma. A, pharma is expensive. B, pharma is extremely news dependent.
The prospects of individual pharma companies will depend more on their strategies. What new products they can get into the markets, and how they can grow the market share of the products and so on. So our exposure to pharma is based on the individual strengths of those companies, and the companies we are tracking them very closely, and we believe that they continue to have good earnings growth prospects and will enjoy good levels of profitability, and we see value in them.
Do you think there is value in something like Sun Pharma? It's trading at 35, 36 times. It's a great company, it's a great franchise, but as a fund manager, are you happy to pay that premium for quality?
Sun Pharma is not a major exposure for us within our pharma portfolios. Other than that, I would not like to comment on the specific stock.
Let's talk about the election, the big event. Irrespective of the event, are you likely to maintain a same portfolio stance, or before election your portfolio could see a big change because election will be a market moving event?
We are always re-evaluating the holdings in our portfolio, and so when we look at stocks and when we review them every quarter and sometimes more frequently, we look into all the economic factors that are going to affect their long-term prospects. It's not that we want to wait for elections to change our portfolio. So we're looking at changes on a week-to-week basis and sometimes on a day-to-day basis. But that doesn't mean that we find ideas that we need to include into the portfolio relative to what we already have. So I'm not sure that the portfolio will change very dramatically because of the elections. But if there is improved confidence about the turnaround of some of the stocks in the cyclical sector, if we believe that the turnaround is not about just one uptick, but about a fundamental change in their levels of profitability and return on capital, yes, I think there will be a stronger case to include some of those names. So we are doing continuous analysis to see how the medium to long-term prospects are changing, and we'll definitely change the portfolio going forward. But as I mentioned before, don't expect a very dramatic change.
But the one I saw today and continues to be, Sukumar, has been quite clearly the banking pack. What's the right approach? Should one start nibbling in at least into the private banking names because the valuations are now looking attractive? Or do you think the market is going to throw up many better opportunities, considering it seems like we're far away from the asset quality stress to be bottoming out?
We find value in number of private sector banks. So we would like to be invested in those names, and the banks would also benefit if there is going to be a increase in the growth rates. I think there's no reason for us to believe that we need to be underweight the private sector banks, and we would like to be adequately exposed to the names we like within that